All right, Michael, stay with us here. We've got about 10 seconds to the closing bell on Wall Street and a relief bell, let's call it, at a minimum today. We're going to see where we settle out, but as we head towards that close, the Dow is off 2,200 points. We've got all three major indexes down 5%. Just looking at some of the big names here, looking at a screen with the Mag 7s. Tesla's down 10%, JP Morgan, which I count as a Mag 7 in my own head, off 7%, Apple down 7%, Nvidia down 7%, Berkshire Hathaway down almost 7%, and we are very near bear market territory on these major indexes, and we have gotten there quite quickly. Remember, for the S&P 500, we closed at a record high on February 19th of this year, and that has haunted me the whole time, because in 2020, we closed at a record high on February 19th, and then we bottomed by March 23rd. So this has been actually a little bit more of a protracted decline than we even saw in COVID, and this feels like it happened in a blink. But certainly it feels just like a head-spinning kind of 2 days here, Joe, and trying to make sense of what you grab onto, really, heading into next week.
Well, at this point, I think you don't grab onto anything. Either you've got this properly hedged out, so if the market goes up, you're not making money, but if it goes down, you're not losing money, or you've just moved to cash, because other than that, you're just going to be dollar cost averaging this over time, and you're not exiting the market, which, hey, if you're there, that's not the worst place to be at this point with the market down. I think we're down almost 10% over 2 days now.
Yeah, just about. Michael, one last one with you before we head down to the floor. I'm just curious, when you look at this kind of market action, again, from a portfolio construction standpoint, an allocation standpoint, does it feel like everything's just getting sold? I know Corey went through some of the details maybe on an individual name, but some of this selling, the magnitude that we've seen in some of these names, these sectors, it kind of feels like people called up on Thursday morning and said, get me out of everything, and it's taken 2 days to get there.
It's sort of interesting. We were looking at market action yesterday, and yeah, we were down 5% on the major indexes, but the selling actually felt kind of orderly. You didn't see the VIX explode higher like you would expect it to in an environment like this. You're starting to see the VIX go a little bit higher today, and maybe having a little bit of discussion about a capitulation moment. We're not seeing it widespread enough to say the bottom is truly in. But it seems that quite a few investors were looking to take wholesale risk off the table. And actually on the other side, you were seeing retail flows actually starting to come in and maybe trying to buy the dip a little. I'm not sure if we saw that today, but we definitely saw that yesterday.
So yeah, we'll see where those net out. I saw a headline from JP Morgan, I think, most retail buying in a couple of years, something to this effect. So billions from that market coming in. And I guess
Bulls rush in.
Yeah, well, we could take our conversation about the group text offline, but I'm sure those were flying in as well from our folks outside the industry. All right, Michael Reynolds, VP of Investment Strategy at Glenmead, thanks so much for the time. Let's go down now to the floor of the New York Stock Exchange. Jared Blickery is standing by for a closer look at today's market action. And Jared, what ended up being, kind of a messy close, as you would have expected?
Yes, very loud here, especially for a Friday afternoon. Let's go to the Wi-Fi Interactive, where I am dialing up the performance for the Dow Industrials for the day, down 2,231.07 points. That's worth 5.5%. You look at the two-day totals, down almost 10%. It was only yesterday the Dow wasn't even in correction. Today it's in correction on the verge of a bear market. So a lot happens in 24 hours. Let's take a look at the 5-day totals, down a little bit better than that, almost 8%. Here's the S&P 500, down 6 today, down 9 for the week. We'll take a look at the NASDAQ, very similar story, down 10 for the week. And finally, the worst off, small caps, down, actually not the worst off, down just under 10%. So let's take a look then at some of the sector action and see how the week closed out. And we will do, this is what happened today. Everything dark red. I have not seen this in a long time, maybe 2022, maybe even 2020. The least worst off is consumer staples, followed by consumer discretionary. So the two consumer staples, not quite as bad as energy. That is double those losses, down almost 9%. Financials off 7, tech 6.5, industrials also more than 6, and materials, throw them in too. I'll quickly show you the 5-day totals, and you can see energy down almost 15%, tech over 10, so are financials. Staples off 2.3%. They were actually in the green yesterday. And then I almost hesitate to look at the NASDAQ 100 heat map. I count 4 little green squares. MicroStrategy, Keurig Dr. Pepper, Ross, and maybe one other. But let's focus on the big guys here. Apple down 13.5%, Meta down 12.5%, Tesla down 9%, Broadcom down 13.5%. And just looking inside the tech sphere, we can see a lot of semiconductor stocks down more than 10%. KLA, NVIDIA, AVGO, Texas Instruments, Intel, all down more than 10%. Intel, by the way, was green yesterday. So in the same vein of not seeing panic selling yesterday, seeing a little bit more panic today, although not full-blown panic. I don't think that we've seen anything like that just yet, just recalling the dark days of 2020. Here's software, pretty similar story, not quite off as worse off as the semiconductors. And then I want to go to innovation as well. Unprofitable tech, not surprisingly, a lot of these stocks down quite a bit. And I'm going to show you, I'm going to go back to the NASDAQ, I'm going to close here. Here is the equal weight. This is just what happened this week. Some of these stocks down over 20%. And if I dial up the meme stock page, it doesn't look that much worse. In fact, arguably, it looks a little better. So the big guys and the little guys really just got clobbered this week, and there's not really any other way to put that. Back to you guys.
All right, Jared, we'll check in with you in about 20 minutes. Second person that we've heard in the last 15 minutes here, guys, telling us that the market's down 5%. It doesn't feel like panic selling. So I guess we've got something to go this week. You know, Jared called out MicroStrategy there, one of the names in the green, and Corey, something we haven't talked about in today's show is Bitcoin, which held in pretty well today.
Like I said, Bitcoin is a store of speculation, not a store of value. Today, rallying a little bit, but Bitcoin's had a pretty rough month of things. But I think it is interesting here. So again, earlier this week, I was at an optical networking conference where there was a lot of talk about AI and data center build out. And we had this earlier guest say that the Mag 7 are all going to see, are seeing tough time. No one's buying fewer NVIDIA chips this year. All right, nothing's getting worse for NVIDIA. Nothing's going to get worse for Broadcom this year. Now, you can look at companies, Apple, with these tariffs, in a much worse position than they've been in. Microsoft, maybe not. So this is some indiscriminate selling here. And I think that the indexes, and we know that it's a passive market and so on. But I think that when there are individual names on sale right now, I'm not giving any stock advice here, but there are companies whose stocks prices are down significantly right now, even though their businesses are not going to change because of what's happening with tariffs. And secondarily, when you sort through those, don't get confused by the way that Google, Apple, Alphabet, whatever, makes money, but I really mean Google makes money, or how Meta makes money. Those are advertising-driven businesses. And the first thing to go in a recession is advertising. It's the canary in the coal mine. So those are concerns, even though they are tech companies.
You know, I know it's fanciful to draw parallels to the early pandemic, but I'm going to pull rank and age here. Now, what this feels like is late 2007, early 2008, when the hedge funds started to blow up in housing, because what we're seeing is the systemic risk is
before the banks went.
Before the banks went, that's right. Yeah. What we're seeing here is the Mag 7 in big tech, and it just feels like we got a lot more ways to go. Remember, we did not get through that point until the backstop was put in. Here's the thing. Someone's going to have to come in and backstop this at one point for it to stop, whether it's Warren Buffett or whether somebody's going to find an off-ramp over at the White House. One of those two things is going to happen.
So commentary from the White House, a big buyer saying I'm buying,
yep,
which probably isn't going to happen.
Yeah.
Someone in the White House who's got a view different than the president's.
That's right.
There isn't anyone in the White House who has a view different than the president's.
Well, I don't agree with that. I think they do, but someone's going to have to go fall on a sword and take the abuse from the president to tell him, Mr. President, it's time to take the off-ramp.
There's going to be cheeseburgers on the wall this weekend.
There is going to be.
Joe, just quickly on that point, so is degrossing a fair characterization of what this market feels like? Just lots of taps on the shoulders? Say, hey, you got to get out of this. I don't care. Get out of it.
Get out of it.
Get out of it.
Yeah, need, right now is about preservation of capital. When you get a vote of no confidence by the market in a major government policy, it needs that condition needs to come to an end, because no one's going to win if it continues.
But this isn't like when the market tanked in the face of a government shutdown. And
I agree, it is not.
That was
like
a one-day thing,
and
that looked like the market saying, "We're going to show you this is a bad idea," and the White House turned it around. That's
right.
Not this. This is something else.
Well, we're going to have to figure out what this is.
Well, I mean, what I hear you guys saying is like, no one out there right now has a good reason to buy or buy more. Or say, I want to get longer, or whatever.
There's no reason to look. This is not the great rotation, what people were talking about earlier this morning. This is something else.
All right. We'll have a lot more on all of this coming up. But we also want to talk a little bit more about what's going on with Trump's economic policies. Rick Newman is going to stop by for that conversation coming up right after this. Right, if a surgeon operates needlessly on a patient, it's medical malpractice. So if a policymaker destroys value, endangers livelihoods, and lowers living standards, is that economic malpractice? Joining us now to make the case is Yahoo Finance's Rick Newman. Rick.
It's economic malpractice on an unprecedented scale. Would like to say hello to Joe Bersalis there. How you doing, man?
Hey, Rick, good to see you.
So what President Trump said yesterday, using this medical metaphor, is one of the most idiotic and regrettable things that any president will ever say in American history. And just to remind people who might have missed it, Trump said, referring to his tariffs, the operation is over. The patient lived and is healing. The patient will be far stronger, better, and more resilient than ever before. This is complete nonsense. So just to break this down, number one, Trump says the patient, the U.S. economy, was sick and in need of surgery. That is false. The U.S. economy was doing well before Trump took office. Now it actually is sick because of Trump. And the patient is not doing well. The patient is hemorrhaging. That is what is happening in markets. And markets are only foretelling what is going to happen in the real economy. There is only one person in the world who doesn't realize what a disaster this is, and that is Donald Trump. There might be a second person you could finger, which is Peter Navarro, his trade advisor. And as you guys were discussing before, who might be the fall guy for this? If there's anybody, I think it might be Peter Navarro, who already went to prison once on Donald Trump's behalf and might take the pain again. We can only hope that that is what Trump does, that he finds a scapegoat and says, this was all somebody else's idea, I'm calling the whole thing off. Because if he doesn't, as Joe and basically every other economist in the world knows, this is a nightmare.
Rick, you make the case of how the president's messed up, but he has made the case that we've been being ripped off by the tariffs other countries have been charging us. And I don't know if you've made the case that every country out there that we're now charging tariffs to, that the American consumers will be paying for, have been ripping us off. But isn't it the case that some countries have been ripping us off?
I don't think so. I think some countries have been cheating on trade. I mean, I think there are a lot of people who would say, yes, China cheats on trade. It uses a government-run economy to subsidize the big state-owned enterprises and other things like that. Yes, we do have a problem with people and communities that used to rely on good-paying manufacturing jobs that aren't there. But blowing up the whole economy is not the solution. To go back to the medical metaphor, you don't operate on the entire body from head to toe to fix a pimple or something. I mean, address the problem in a targeted way. And there are tons of ideas for how to address these problems in targeted ways. There are ways to crack down on China's cheating. Other countries do it as well. It's too complicated to get into in one segment, but there are many ways you can do that. With the places that we need better paying jobs for people in America who do not have college educations, there are also many ways to address that problem. We need more tradespeople. That is not assembly line workers making socks that we don't want to pay for in America. It is people, it's plumbers and welders that we need to do jobs that are good paying jobs. Many companies need skilled workers that they can't get enough of, and they're trying to line up with local government and state governments and say, here are the types of workers we need. Can we get these people in the pipeline to get these skills? All these types of things. Do that kind of stuff. Why make everybody 25 or 30% poorer in order to bring back 100,000 automaker jobs? This is insane.
All right, so the late great Herb Stein used to tell us that if something bad goes on long enough, it usually comes to an end. How do we get out of this, Rick? What's the way forward?
Well, Joe, I mean, you would be the one who could put numbers on this. If Trump were to reverse this quickly, we could get out of it without too much damage. But the longer these tariffs stay in effect, the more this damage becomes irreversible. I mean, to go back to the metaphor, Trump is not going to kill the patient. He can't kill the whole U.S. economy. Thank God. I mean, the U.S. economy will survive all of this in some form. But we're going to survive with less. I mean, this is demand destruction and value destruction. You don't just automatically get it back if it stays in place long enough. So I don't know. I mean, this is a real test of how responsive the political system actually can be when you have a man-made crisis on your hands. And much of this is unprecedented. I mean, Trump has figured out that he doesn't have to answer to anybody on tariffs. He knows that he doesn't have to run for re-election unless he tries to. so he doesn't have to answer to voters in that way. So we are in a predicament here, and this all comes down to how hard-headed is Trump actually going to be?
All right, Yahoo Finance's Rick Newman. Rick, appreciate the time.
Hi, guys.
And staying on that theme of just how these policies square with Trump's voters, his constituents, and the way these start to play as the political process begins to move past this shocking week. Joining us now to talk about that and a little bit more is Kim Wallace, 22V Research Senior Managing Director. So Kim, let's start with something you flagged in your note to us about April 11th being the day that Congress is they're going to head back and they're going to start hearing from their folks. And do you expect that could start to put pressure on the administration to really think about the impacts that these policies are already beginning to have, in the real economy?
Oh, I do. But the question is, as Rick was alluding, is it effective? Does it cause a course correction? From about the 11th of April through the 28th, members of Congress are scheduled to be on their annual spring break. The feedback loop is pretty lively, and it's growing, it's intensifying. Just this week, we've had Trump allies, Senators Cruz, Senators Grassley, Senator Ron Johnson started it on Tuesday, all come out explicitly in interviews saying how disastrous the current tariff policy is for their constituents, their states, and the nation. So it's already begun. It's going to get louder and more intense so that you'll see this feedback, I believe, continue to spill over into political risk aversion that lately has stalled fiscal policy action, oddly enough. That political risk aversion, if it goes on too long, say another 2-3 quarters, definitely implies electoral risk aversion going into the midterms next year.
Well, what gets the president's attention? Is it a group of senior senators? Is it the Speaker of the House of Representatives? Or is it within his kitchen cabinet and some of the donor class that says, hey, this is a bad idea. We might want to stop this now before it results in an economic catastrophe?
I'm not a really good source on what motivates President Trump, but I would say that, at least from a policy standpoint, I would say that the friend circle that he reportedly keeps, most recently to tally votes on whether or not the National Security Advisor should keep his job, I would think the people he's been close to the last 2 decades in investment and business on the U.S. side would be the sounding board most important. If it's true that the president got in a nice round of golf today, I congratulate him. I'm envious of him. But maybe those are the people who have to eventually tell him this is not working. If that's the case, we're weeks, if not months away from that happening.
So inside Wall Street, there's a not so quiet conversation going on that this equates with what Richard Nixon did when he took us off the gold standard. Does the president and the circle around him understand the policy implications of ending the dollar's reserve status and just what the loss of purchasing power will mean for his base constituents?
I think they do, certainly in an academic standpoint. Part of the difficulty with this week and the trade policy is that most of the people developing this policy, outside of Mr. Greer at the United States Trade Representative, have no public policy making experience. They're not accustomed to collaboration for these, if you will, the constitutional greater good. And so it's easy to talk yourself into theory like optimal trade theory that at its base works only if no one retaliates. Well, we know that's not the case, so that's out the window. So part of the problem with this week, both in the substance presented and in the process itself, is too few hands, and too few hands with experience, and too few hands with experience that have connections to how geopolitics and diplomacy work in real time, in my view.
And let me suggest, if the saying is many hands make light work, too few hands are going to make this hard work. It does seem to me that there's and I've read this suggestion out there that when President Trump talks about individual cutouts from these tariffs that can only be negotiated by him, it puts him and his business interests and his friends' business interests in a really uniquely powerful position where cutouts around tariffs create personal and professional economic power around the only individual who can make those cutouts. Is cutouts, I should say. Is that something to look out for? Is that something you fear?
I don't say I fear it. It's something that we know happened in the first term. There's an NBER paper out that puts a fairly high correlation between political action giving and companies and sectors that received relief in 2018 and 2019 from tariffs. You would go on to observe further that the president's inner circle, his cabinet, family and friends certainly have benefited from his return to office. I've had people ask me if there's any data on whether or not they are as exposed to or were as exposed to the U.S. equity markets, say, 2-3 weeks ago as they might have been 2-3 years ago. So that notion is going around. That's not helpful to a White House attempting to build confidence around a transformative policy that, as everyone has said.
But are they trying to build confidence? I mean, we assume they would want to build confidence, but clearly that's not what they're trying to do here. Maybe what they are doing is something different.
If you believe their program, which they say will be a necessary adjustment that might cause a little pain, the Secretary Bessent used the term detox. If they believe that they can manage the U.S. through a contraction that reduces consumption, reduces pressure on prices, devalues our debt, and makes it easier on the back end to service that debt, if they really believe those theories, then that might be the program they're after. My guess is reality is going to present them with counterfactuals day one through forever. Getting back to your point of when does the feedback loop force them to recognize that what they are achieving is hard to do in the process that they've laid. Go back to, if you will, you mentioned President Nixon and gold standard. Paul Volcker spent a lot of time with the president and other advisors and internationally selling that. James A. Baker spent a lot of time with G10, then G7 trading partners to explain what Plaza Accord was upfront and over time what it would mean. To do transformative international policy, especially around geoeconomics, you have to bring people along. You have to convince them that there's an upside for them in participating. Otherwise, they're not going to participate. They're going to fight you. And we see a strengthened G20 relative to 8 years ago, certainly relative to 50 years ago, pushing back.
All right, so Kim, let's get out on this. We've talked a lot about the president's inner circle, who he's listening to. What are the tools that Congress may have if it turns out that his constituents are ultimately opposed to these set of policies to try and either reverse, influence, or change what we've had announced from the White House in the last couple days?
Of those options, I think influence is probably the only viable one. That is quiet conversation, to the extent that the White House is willing to continue to entertain it from Capitol Hill. But the notion that you have a chance at legislation this year that will blunt what the president has announced, I find to be fanciful. You need 291 votes in the House and 67 in the Senate to overturn a veto. Those votes are unlikely to be there unless the pain 4, 5, 6 months from now is so incredible that there's no option for members of Congress more worried about themselves than being loyal to the president. But that is a lot of pain between now and that point. Nor do I believe the third branch is a quick relief mechanism here. Yes, there are a lot of lawsuits in the federal judiciary challenging this president's executive authority. They will take time to win through the process. It may be another 2 or 3 quarters before you have a Supreme Court ruling specifically on trade policy under the International Emergency Economic Powers Act or broadly on executive authority. So near term, persuasion is probably the only tool available.
All right, Kim, appreciate the time. As always, Kim Wallace with 22V Research. All right, time now for what to watch next week. Let's start off on the tariff front. As the market sell-off continues, President Trump's Liberation Day tariffs are set to go into effect over the weekend and next week. A 10% tariff on all countries takes effect at 12:01 a.m. Eastern on Saturday, and individualized reciprocal tariffs are scheduled for midnight on Wednesday. On the earnings side, another season is kicking off. Big banks leading it on Friday. JP Morgan, Wells Fargo, and Bank of New York Mellon will all report their results. We'll also get results from companies including Levi's, Delta, and CarMax throughout the week. Now, over on the economic data side, we'll get fresh inflation data out next week with the consumer and producer price indexes, CPI, coming on Thursday. Economists forecasting total CPI to slow to 0.1%. Core CPI ticks up to 0.3% on a month-over-month basis. On the producer side, PPI out on Friday. Economists see total and core PPI increasing to 0.2% and 0.3%. respectively. And finally, the Fed will release the minutes from March's FOMC meeting on Wednesday, the minutes giving us more insight into the discussions and deliberations held at the Fed ahead of its interest rate decision to hold rates steady last month, I guess, now at this point. All right, that's going to do it for Market Domination today. Huge thanks, as always, Corey Johnson, Joe Brasuelas. Thanks for stopping by for the full 90. That was fun. Couldn't imagine a more momentous day to have that fun. All right, on the other side of the break, it's going to be Asking for a Trend. Got you covered with the latest and greatest market-moving stories to get ahead of the themes affecting your money. Stay tuned for that right after this.